Ever wondered how financial auditors become the ultimate financial detectives? Sifting through mountains of data to make sure everything is actually on the up and up?
Or maybe how they spot trouble, like before it even starts,
Yeah.
preventing those potential financial headaches.
Yeah, exactly.
Well, today we're on a mission to unravel that very mystery.
Hmm.
We're diving deep into the fascinating world of how auditors identify, assess, and then respond to risks in financial statements.
Okay.
Our goal really is to pull out the most important insights, help you understand not just what auditors are doing,
Right.
but why their work, all that meticulous detail, is absolutely crucial for, well, safeguarding financial integrity and making solid decisions.
Hmm.
We want to break down the jargon, make it really clear.
And we've pulled together some pretty robust material for this deep dive, haven't we?
We have. It's straight from a text called Identifying, Assessing, and Responding to Risk. And we're really focusing in on the auditor's strategic approach.
All right, let's crack open this case file then. So, like any good detective, the first step is always understanding the scene, right?
Absolutely fundamental.
Before an auditor can even think about fixing anything, they first have to figure out what might actually be broken.
Mm-hmm.
And this investigation, it kicks off with really getting to know the company, its business, its environment.
And critically, it's internal controls. You've got it. It's like mapping out the entire building before you even start looking for clues.
Makes sense.
So auditors start by identifying and assessing what we call risks of material misstatement.
Okay, risks of material misstatement. Big phrase.
It is, but think of these risks on two key levels, almost like zooming in on a map.
All right.
First, you've got financial statement level risks.
Okay.
Now, these are the big pervasive risks, the ones that could potentially affect the financial statements as a whole.
Ah, so not just one specific account.
Exactly. They could potentially taint the entire financial picture. They're widespread.
So these are like the systemic vulnerabilities, like finding a crack in the foundation of the whole building, not just a leaky faucet in one room.
That's a perfect analogy. And they're especially critical because they often point towards the possibility of fraud.
Right.
Imagine a company where, say, the financial reporting team lacks the right experience, or maybe the whole process for putting together the financial statements is just chaotic.
Uh-huh.
That creates a risk across all the accounts. Or perhaps the company's overall system of internal control has significant weaknesses. These are the kind of broad stroke risks we're talking about.
Okay, got it. So that's the wide view.
Then we zoom in, we look at assertion level risks.
Assertion level.
Yeah, these are much more specific. They're tied to individual transactions or account balances or maybe disclosures in the notes.
Okay.
And for these specific risks, auditors assess two distinct components: inherent risk and control risk.
Inherent risk. That sounds like maybe the natural susceptibility of something to go wrong, even before you factor in any safeguards. Is that kind of the idea?
You're absolutely spot on. Inherent risk is exactly that. It's the susceptibility of a particular account balance or maybe a type of transaction to be misstated
Okay.
before we even consider any of the company's internal controls. Think of it like asking, how dangerous is this mountain trail itself? Forget about guardrails for a second. Just how steep or rocky is it?
Right, the baseline risk.
Precisely. The likelihood and the potential size, the magnitude of a misstatement are key here, along with various other inherent risk factors. Auditors use their professional judgment, to place this risk somewhere on a spectrum. Could be low, could be very high.
Okay. And then control risk.
Yeah.
That must be about whether those guardrails, the company's internal controls, are actually going to work, if they'll catch an error.
That's it, exactly. Control risk is the chance that a misstatement that could occur, well, it won't be prevented or maybe it won't be detected and corrected by the company's own internal controls. So if those guardrails on the mountain trail are flimsy or maybe they're just not there in places,
Then your control risk is high.
your control risk is high. And this assessment, it's based on the auditor's understanding of the controls the company says it has, and also their plan for testing how effectively those controls are actually operating in practice.
So clearly not all risks are created equal then. Some must demand way more attention.
Definitely.
Which leads us, I guess, to what auditors call significant risks. What pushes a risk over the line into being significant versus just, well, a regular risk.
Yeah, this is where things get really critical.
Ah.
Significant risks are those identified risks of material misstatement, where the inherent risk assessment is judged to be very high.
Very high.
We're talking close to the upper end of the spectrum high.
Okay.
And what's fascinating here, and actually often misunderstood,
Yeah.
is that determining if something is a significant risk completely ignores the effective controls. It's purely about the raw inherent danger.
Really? So you don't even look at the controls at this
And
stage?
not for classifying it as significant, no.
Yeah.
It's like assessing that cliff's danger based purely on its height and how jagged the rocks are. Not based on whether there's a fence at the top. The fence, the control, that comes into play later when we decide how to respond, but the significance is based on the inherent danger alone.
That cliff analogy really helps visualize it. Okay, so if the inherent danger is that high, what kind of things scream significant risk to an auditor? What are the red flags?
Well, several things immediately jump out. Any risk of fraud, for instance, that's
Yeah.
almost always considered significant, no question.
Makes sense.
Then you have situations involving significant emerging economic or accounting developments, things that could really shake up the financial statements.
Okay, big changes.
Big changes, yeah. Also, unusual or highly complex related party transactions.
Ah, dealing with insiders.
Exactly.
Yeah.
Think of companies doing business with entities owned by their own executives or board members. That can get murky, so it needs a close look.
Mm.
Improper revenue recognition is another
Yeah.
classic one,
Yeah.
especially with complex contracts where it's hard to value exactly what's been delivered. Always a hot spot.
I bet.
Also, non-routine, unusual, or highly complex transactions. They don't happen often, so there might not be well-established controls around them.
Right, the one-offs.
The one-offs, yeah. And finally, things like highly subjective accounting estimates where there's a lot of judgment and uncertainty involved.
Like predicting the future, almost.
Kind of. Or even just accounting principles that are open to different interpretations. Those can also trigger the significant risk classification.
So pinpointing these significant risks really helps the auditor focus their firepower, doesn't it? It sounds like this is where the real potential for financial landmines might be buried.
Absolutely. It directs their attention. And for each identified risk, whether significant or not, the auditor has to think very specifically, what could go wrong here at the assertion level? How big and how likely is a potential misstatement?
Right.
And crucially, are tests of the company's controls going to be enough? Or do we need to dive straight into testing the actual numbers with substantive procedures? They also figure out if the risk is specific to one area or if it's more widespread.
And I know for the big guys, the publicly traded companies, the PCAOB, that's the Public Company Accounting Oversight Board, they have some pretty strict standards.
They do. Very stringent.
So how do auditors keep all this straight, especially when the company might have operations all over the place? How do they ensure their findings are reliable?
Well, under PCAOB standards, auditors are required to identify significant accounts and disclosures based on their inherent risk, remember, regardless of the controls.
Okay.
They have to look at both qualitative factors, the nature of the risk, and quantitative factors, the dollar amounts, even if a company has operations spread globally.
Wow.
And to your point about reliability and keeping it straight,
Yeah.
documentation is absolutely
I just
paramount.
imagine.
Auditors must meticulously document everything from team discussions about potential misstatements, their understanding of the entity, its environment, its controls, how they evaluated the design of those controls, whether they were implemented, and of course all the identified and assessed risks, financial statement level, assertion level, especially the significant ones, and crucially, the rationale for the judgments they made. Why did they decide this was high risk? Why did they choose that procedure?
So a complete record.
A complete record. And for companies with multiple locations, the PCAOB guidance is clear. Auditors need to align their audit effort with the risk profile of each specific location or business unit.
Ah.
They look at things like the nature and amount of transactions there, the materiality, any specific risks unique to that site, how centralized the record keeping is, the local control environment, monitoring activities. All that feeds into how much attention that location gets.
So the documentation isn't just, paperwork for its own sake.
Not at all. It ensures transparency, it ensures accountability, and it creates a clear audit trail. Think of it like a comprehensive case file that any or another auditor or regulator can review and understand exactly what was done and why.
Okay, so our financial detectives have gathered the clues, they've assessed the potential risks, they've documented everything meticulously. Now, for the really crucial part, how do they actually respond to these identified threats? How do they make sure the books are ultimately clean? Time for the action plan.
Exactly. Once the risks are identified and assessed, the next step is developing specific responses.
Yeah.
The whole goal is to bring the overall audit risk, the risk of issuing the wrong opinion, down to an acceptably low level.
Right.
And broadly speaking, these responses fall into three main categories.
Okay.
First, there's an overall response to tackle those broad, pervasive financial statement level risks we talked about earlier.
Hmm.
Second, there's a response at the relevant assertion level. This means tailoring the specific audit procedures, their nature, extent, and timing for each specific risk related to accounts or transactions.
Gotcha. Tailored approach.
Very tailored. And third, there are specific responses designed just for those identified significant risks. They get special attention.
Okay, let's break those down. Starting with the big picture. Those broad, systemic financial statement level risks. How do auditors tackle something so widespread?
They implement several strategic adjustments across the whole audit. For example, they might communicate an increased need for professional skepticism to the entire audit team.
Kind of like putting everyone on higher alert.
Exactly.
Mm.
Sharpening everyone's detective instincts. They might assign more experienced staff or maybe people with specialized skills to the engagement.
Makes sense.
They could also increase the level of direction, supervision, and review of the team's work. Another key strategy is incorporating more unpredictability.
Oh, like surprise tests.
Surprise visits, unexpected tests, changing the timing of procedures year to year so the client can't anticipate everything, keeps them on their toes.
Clever.
Auditors might also make changes to the overall audit strategy itself. Maybe they adjust performance materiality or decide to shift more of their substantive testing closer to the year-end to get a more complete picture right before the financials are finalized. And under PCAOB standards, this overall response also explicitly includes a rigorous evaluation of the company's significant accounting principles, making sure they've selected appropriate ones and applied them correctly.
Right, that covers the overall response. Now,
Yeah.
you said the next part is where it gets really interesting. Designing procedures for those more specific assertion-level risks. This sounds like the real boots-on-the-ground investigation.
It absolutely is.
Hmm.
This is where the detailed work happens. The core principle here is simple but critical. Every audit procedure must be designed to directly address the specific risk of misstatement for each relevant assertion.
So, a clear link.
A clear logical link between the risk we identified and the procedure we perform. You have to be able to explain why you're doing that test for this risk.
Right.
And woven through all of this, auditors absolutely must maintain intense professional skepticism. We can't just accept management's explanations at face value. We need corroborating evidence. We can't afford to be biased or just assume things are correct.
Constant vigilance.
Constant vigilance. And to help design these procedures, we often use a handy acronym, NET.
The net. Okay, unpack that for us. What does net stand for?
Sure. N stands for nature. This refers to what kind of procedure we're doing.
Okay.
It covers both the purpose, is it a test of a control, or is it a substantive procedure directly testing the financial numbers, and the type of test. Are we inspecting documents, observing a process, making inquiries, sending confirmations to third parties, recalculating figures, reperforming a client's process, doing analytical procedures?
Lots of options.
Lots of options. And the higher the assessed risk for a particular assertion, the more persuasive the evidence we need. So the nature of our procedures will shift. We might rely more on inspection or reperformance for high-risk areas rather than just inquiry.
Okay, more robust tests for higher risks.
Exactly. And also, if the entity relies heavily on its IT systems, testing the nature often involves testing the accuracy and integrity of the information produced by those systems. You can't rely on a report if the system generating it isn't reliable.
Good point. Okay, that's N for nature. What about E and T?
E is for extent. This is pretty straightforward.
Yeah.
It's about the quantity of the procedure performed.
How much testing?
How much, yeah. How many invoices do we look at in our sample? How many observations of a control do we make? How many locations do we visit? Again, higher risk generally means we need a greater extent, a larger sample size, more items tested. We also consider tolerable misstatement here, basically. How big an error would need to be before we consider it material.
Got it. And T.
T is for timing. This is about when we perform the procedures.
Okay.
Do we do them at an interim date, say halfway through the year? Or do we wait until the period ends? Generally, the higher the assessed risk, the more likely we are to perform substantive procedures closer to or at the period end.
Why is that?
Because testing at year-end gives us the freshest, most relevant evidence about the year-end balances. Testing mid-year, while it allows for earlier identification of issues.
Right.
It also means we have to do additional work to cover the remaining period between the interim date and year-end. So there's a trade-off. We also have to consider, practically, when the information we need is actually available. Some things you can only test at your end.
So auditors use this net framework, nature, extent, timing, to design their specific tests based on the risks they found.
Precisely. And depending on the risk assessment, particularly the assessment of control risk, they might take different overall approaches for assertion-level risks.
Okay, what are those approaches?
Well, one option is a substantive approach only.
Substantive only.
Yeah. This happens when the auditor decides not to rely on the company's internal controls at all for a particular assertion.
Right.
Maybe the controls are assessed as weak, or maybe it's just more efficient to test the numbers directly. In this case, control risk is assessed at the maximum,
Right.
and no tests of controls are performed for that assertion. They go straight to rigorous substantive testing of the account balance or transactions.
Okay, so they rely entirely on their own direct tests. What's the alternative?
The alternative is a combined approach.
Combined, meaning controls and substantive.
Exactly. This approach uses both tests of the operating effectiveness of controls and substantive procedures. The logic is pretty straightforward. If the auditor tests the controls and finds they are working effectively, then they have some assurance that the company's own systems are helping to prevent or detect misstatements. This allows them to potentially reduce the nature or extent of their direct substantive procedures.
So effective controls mean maybe less direct testing needed from the auditor.
Potentially, yes.
Yeah.
It provides a basis for reducing the amount of substantive assurance needed. However, there are situations where tests of controls aren't just optional for a combined approach, they might actually be required.
Oh, when is that?
This often comes up when a company makes extensive use of information technology, IT.
Okay.
If transactions are initiated, recorded, processed, or reported primarily electronically, there might not be much or any traditional paper documentation to examine.
Right, everything's digital.
Exactly. Think about highly automated routine transactions, like online sales or automated billing. There might be very little manual intervention. In those cases, the only way to get assurance is often by testing the automated controls within the IT system. The reliability of the electronic audit evidence really hinges entirely on the effectiveness of those IT controls over its accuracy and completeness.
So if it's all in the system, you have to test the system's controls.
You pretty much have to, yes. Substantive procedures alone just wouldn't be sufficient in those cases.
Gotcha. Now, you also mentioned dual-purpose tests earlier. That sounded efficient. Can you explain those a bit more?
Absolutely. Dual-purpose tests are a great example of audit efficiency. They're cleverly designed tests that serve two purposes at the same time, with the same sample of transactions.
Two birds, one stone.
Pretty much. The test simultaneously evaluates the operating effectiveness of a specific internal control and detects potential material misstatements in the dollar amounts of the transactions themselves.
Okay. So you're checking the control and the number in one go.
Exactly. For example, you might select a sample of sales invoices. You could check that the control requiring credit approval was followed, testing the control, and at the same time, verify the accuracy of the invoice amount and that it was recorded in the right period, substantive testing. Very efficient when you can design them properly.
That makes a lot of sense. So could you maybe summarize the relationship between how an auditor assesses internal controls and the amount of substantive testing they end up doing?
Sure. Think of it like this. If the auditor assesses internal controls as weak or non-existent for an assertion, they can't rely on them. Control risk is high, or maximum.
Okay.
In that case, they perform no tests of controls, unless required by extensive IT, as we said, and they have to perform the maximum amount of substantive procedures needed to get sufficient evidence. They're doing all the heavy lifting themselves.
Right, makes sense.
Now, if controls seem potentially effective, maybe control risk is assessed as medium or low, the auditor will perform tests of controls to confirm that assessment. If those tests show the controls are effective, they can then reduce the extent of their substantive procedures. They still do substantive testing, but maybe less of it.
Okay, so strong controls allow for less substantive work.
Exactly. If controls are assessed as strong and tests confirm they operate effectively, low control risk, the auditor can justify performing the minimum necessary substantive procedures. But crucially, they can never eliminate substantive procedures entirely for significant account balances or transaction classes. You always need some direct testing of the numbers.
Never zero substantive testing. Got it.
It's essentially an inverse relationship. The stronger and more reliable the internal controls, the less direct substantive testing the auditor needs to perform, but you always need that direct check on the key figures.
That relationship makes perfect sense. Okay, let's circle back to those significant risks, the really high danger ones. What specific extra steps do auditors take when they've identified one of those?
Right. Significant risks demand special attention and elevated procedures. For every significant risk identified, the auditor must evaluate the design of the company's related controls and determine if they've actually been implemented.
Okay, check the design and implementation.
Yes. And here's a critical point. If the auditor plans to rely on the operating effectiveness of controls to mitigate that significant risk,
Mm.
they must perform tests of those controls in the current audit period. There's absolutely no relying on tests done in prior audits for controls related to significant risks. You need fresh evidence every single year.
Ah, no shortcuts for the big risks.
No shortcuts.
Mm-hmm.
They also have to perform substantive procedures that are specifically designed to be clearly linked and responsive to that particular significant risk. This might mean focusing heavily on tests of details or using a combination that includes substantive analytical procedures specifically targeting that risk.
More targeted testing.
Exactly. And the higher the auditor assesses that significant risk to be, the more persuasive the audit evidence they need to obtain from those procedures.
So the bar for evidence gets higher.
It does. Plus, identifying a significant risk triggers specific communication requirements. Auditors must communicate these risks to those charged with governance, typically the audit committee or the board of directors.
Keeping the leadership informed.
Absolutely. Significant risks are also key factors considered when the auditor determines the key audit matters, or CAMs, which are highlighted in the audit report for public companies.
Okay.
And one more thing, if it's a group audit, like a parent company with subsidiaries, and a significant risk relates to one of the components of subsidiaries, the group engagement partner needs to be much more involved in overseeing the work done on that specific risk.
So heightened scrutiny all around for significant risks.
Definitely. They get the top-tier attention.
Okay, we've covered identifying risks, assessing them, and the overall response strategies. Now let's zoom in on one of the main tools, tests of controls. You've mentioned them a few times. When exactly do auditors decide to perform these tests, and how do they actually do it?
Right. Tests of controls are performed in two main situations. First, whenever the auditor's risk assessment is based on an expectation that the controls are operating effectively. If they want to assess control risk below the maximum, they must test the controls to support that lower assessment.
Okay, if you want to rely on them, you have to test them.
Exactly. The second situation is when substantive procedures alone simply cannot provide sufficient appropriate audit evidence. As we discussed, this is very common when an entity uses IT extensively and relies on automated controls or electronic evidence.
Right, the IT scenario.
And importantly, auditors only test controls that they determine are suitably designed to actually prevent or detect and correct material misstatements. If a control is poorly designed, there's no point testing. If it operates effectively, it wouldn't achieve the objective anyway.
Makes sense. Test the ones that could actually work.
Precisely. And it's important to remember a distinction we touched on earlier. As part of understanding the entity and its internal control, auditors are required to evaluate the design of relevant controls and determine if they have been implemented.
Okay, understand the design and see if it's in place.
Yes, but that initial understanding phase doesn't automatically require them to test the operating effectiveness of those controls, how well they work over time. That testing only happens if they plan to rely on the controls or if substantive procedures alone aren't enough.
So that initial check is like verifying the guardrail exists and seems properly built, but the later test of controls is like checking if it actually stops someone from falling over the edge throughout the year.
That's a fantastic way to put it, yes. Although sometimes during those initial procedures to understand the design and implementation, the auditor might incidentally gather some evidence about operating effectiveness.
Oh, how so?
Well, for instance, observing the consistent processing of transactions by an IT system during a walkthrough might provide some initial indication it's operating effectively. And if it's efficient to do so, an auditor might actually decide to test the operating effectiveness concurrently while they're gaining that initial understanding of the system.
Okay, combining steps, if it makes sense.
Right. But ultimately, if they do plan to rely on controls, they need specific evidence that those controls were both designed effectively and operated effectively throughout the entire period they plan to rely on them. They need to answer, were the controls applied at the relevant times? How were they applied? Were they applied consistently? And who applied them?
Okay, so what's the nature of these tests? What does an auditor actually do when they're testing a control's operating effectiveness?
The nature of tests of controls involves using a combination of procedures, and they range in terms of how persuasive the evidence they provide is.
Okay.
At the less persuasive end, you have inquiries basically asking client personnel about how the control functions. Important, but you can't rely on inquiry alone.
Right, need more than just talk.
Definitely. Then there's observation, watching the control being performed. This is useful, but it only provides evidence for the specific point in time the auditor was watching.
A snapshot.
A snapshot, exactly. More persuasive is inspection of relevant documentation, looking at documents, records, or reports that show the control was performed, like checking for signatures indicating approval, or reviewing reconciliation reports.
Okay, examining the evidence trail.
Yes, and often the most persuasive is reperformance. This is where the auditor independently re-executes the control procedure themselves to see if they get the expected result.
Doing it themselves.
Right. A strong test often involves a combination of these: inquiry plus inspection, or inquiry plus observation. And remember, for testing just the design effectiveness, procedures like inquiry, observation, and inspection, often done together in a walkthrough, are usually sufficient. But for operating effectiveness over a period, you typically need more, often involving inspection or reperformance on a sample of items.
Got it. And what about the extent? How many times do they test a control?
Good question. The extent of tests of controls determines how much evidence we get. More testing generally equals more persuasive evidence.
Makes sense.
Several factors influence the extent. How frequently is the control performed? Daily, weekly, monthly. Controls performed more often usually require larger sample sizes. How long does the auditor plan to rely on the control? The longer the reliance period, the more testing needed. How reliable is the evidence obtained? Reperformance provides more reliable evidence than observation, for instance. Also, are there other tests providing evidence about the same assertion? What's the auditor's desired level of reliance on the control? How much do they want to reduce their substantive testing? And what's the expected rate of deviation? How often do they expect the control not to work? If they expect more errors, they need to test more.
Lots to consider for sample size.
Yes. For controls performed on transactions, we typically use statistical or non-statistical sampling to determine the extent. But for automated IT controls, things can be different.
How so?
Because IT controls tend to be highly consistent. If an automated control is programmed correctly, it will likely perform the same way every single time. So auditors might test fewer instances, maybe just one or a few to confirm it's working, but they also need to test the related general IT controls, things like controls over program changes, and access to ensure the automated control remained effective throughout the period. You also need to test controls over the accuracy and completeness of system-generated data if you're relying on it. And don't forget about testing indirect controls, those that support the functioning of other controls.
Okay, IT controls need a slightly different approach to extent. And finally, what about timing for control tests? When do they do them?
Timing is crucial here too. An auditor needs evidence that the control operated effectively throughout the period they plan to rely on it.
Throughout the period.
Yes. Testing a control only at one specific point in time, say at year-end, only provides evidence about its effectiveness at that moment. To get assurance for the whole year, they might test transactions throughout the year or test controls at an interim date, and then perform additional procedures to update that testing through to year-end.
Updating the interim tests.
Right. For example, if they test controls in October, they need to do something to get assurance over November and December. This might involve inquiring about changes, observing controls near year-end, or testing transactions from that later period. Some controls, by their nature, only happen at period end, like controls over the physical inventory count, so those are obviously tested then.
Okay. Can auditors use evidence from last year's audit?
Sometimes, yes, for operating effectiveness, but with significant caveats. If the control hasn't changed since it was last tested, the auditor might be able to use evidence from a prior audit.
If it hasn't changed.
Correct. However, if the control has changed, or if it's a control designed to mitigate a significant risk,
Those again.
then prior period evidence is not sufficient. It must be tested in the current year.
Okay.
And even if a control hasn't changed and doesn't relate to a significant risk, auditors can't just rely on prior testing indefinitely. They must retest each key control at least once every third year.
Every third year minimum.
Minimum. And many firms have policies requiring more frequent testing, especially for controls they rely on heavily. The idea is also to rotate the controls tested each year to maintain unpredictability. But again, the big exception. Controls mitigating a significant risk always get tested every year,
Yeah.
no exceptions.
That's a really important point. Okay, so after all that meticulous testing of controls the nature, extent, timing, what are the possible outcomes? What happens if the controls, well, don't hold up under scrutiny?
Right, after performing the test of controls,
Mm-hmm.
there were essentially two main paths forward based on the result.
Oh,
Path 1. The test showed the controls are operating effectively as assessed. Great news for the auditor.
good outcome.
Yes. In this case, they can rely on the controls to the extent planned, confirm their initial assessment of control risk, likely low or medium, and proceed with their planned substantive procedures, which might be less extensive because of the reliance on controls.
Okay, plan A works. What's path 2?
Path 2. The test revealed the controls are not operating effectively or not as effectively as initially assessed. The deviation rate is higher than expected.
Uh-oh, not good.
Not ideal. When this happens, the auditor basically has two choices. First, they could try to identify and test alternative, compensating controls that might achieve the same objective. Maybe control A failed, but control B backs it up.
Look for a backup control.
Exactly. But often, the more common response is the second choice. The auditor must reassess control risk. Since the tested controls aren't reliable, they'll likely revise control risk upwards, maybe from low to high.
Okay, increase the risk assessment.
Right. And that reassessment has a direct impact on the net of substantive procedures. They'll need to increase the extent or maybe change the nature to more persuasive procedures or shift the timing closer to year end. Essentially, they need more direct, reliable evidence from their own substantive tests because they can no longer count on the company's controls.
So failed controls mean more work for the auditor's substantive tests.
Directly translates to more substantive work, yes.
And what do these control deficiencies actually look like in the real world? Can you give us some common examples of things going wrong?
Sure. Deficiencies can pop up in two main ways.
Mm.
Either the control was poorly designed in the first place, or a well-designed control simply failed to operate as intended.
Design versus operation. Got it.
So design deficiencies might include things like inadequate documentation of a key process, making it hard to even know what the control is, or a lack of proper segregation of duties, where one person has too much authority, like being able to both authorize and record a transaction. That's a classic design flaw.
Right. Too much power in one place.
Exactly. Other design issues could be poorly designed IT controls, maybe inadequate user access controls, or simply having unqualified personnel trying to perform a control they don't understand. Or even just poor monitoring by management to see if controls are working.
Okay. And operational failures. When a good design breaks down.
Operational failures are when a seemingly well-designed control just isn't executed properly. Maybe someone failed to obtain the required authorization for a purchase, or reconciliations that are supposed to happen regularly just don't get done or aren't reviewed properly. Failure to adequately safeguard assets, leaving sensitive data unsecured, for example. Sometimes it's more subtle, like undue bias creeping into estimates even if there's a process. Or misrepresentation by client personnel, which is a big red flag for potential fraud.
Yeah.
Management overriding controls is another major operational failure. The control exists, but management just bypasses it.
Management override.
Yeah. And simply finding that the actual deviation rate in testing is much higher than expected indicates an operational failure. Or maybe the information systems failed to provide timely and accurate information needed for the control to work. Lots of ways a control can fail in practice.
So when these deficiencies are found, what does the auditor do next, besides maybe increasing substantive testing?
Good question. They need to evaluate the severity of the deficiency. Is it just a minor issue, or could it potentially lead to a material misstatement? They consider if there are any compensating controls, as we mentioned. They then have to decide if the deficiency, either alone or combined with others, rises to the level of a significant deficiency or even a material weakness, terms that have specific definitions and require formal communication to management and those charged with governance.
Okay, assess the severity.
Yes, consider the potential magnitude of misstatements that could slip through, and based on that assessment, they design specific, targeted substantive procedures to directly address the risk created by that specific control deficiency. Find the weakness, then target tests at that weakness.
Okay, that's incredibly detailed on the control side of things. Super helpful breakdown. But ultimately, all this detective work on controls and risks, it eventually has to lead to checking the actual financial figures themselves, right?
Absolutely.
Which brings us finally to substantive procedures. This sounds like where the auditor really digs into the dollar amounts, where the rubber meets the road for the money itself.
It absolutely is. Substantive procedures are the heart of detecting actual material misstatements in the financial statements at the assertion level, things like whether assets exist, liabilities are complete, revenues recorded correctly, and so on.
Okay, finding the errors in the numbers.
Exactly. And the nature, extent, and timing is directly influenced by the assessed risks of material misstatement and, very importantly, the results of those tests of controls we just spent time discussing.
Right, it all links together.
It all links together. But here's a point I really want to emphasize again. Regardless of the assessed level of control risk, even if controls are deemed super effective, substantive procedures are always required for each material transaction class, account balance, and disclosure.
Always required, no matter what.
No matter how good the controls seem, you can never audit by controls alone. There's always a need for some direct testing of the numbers. Auditors must, at a minimum, perform procedures like agreeing the final financial statements, including all the notes and disclosures, back to the underlying accounting records.
Checking they tie out.
Yes. And examining material journal entries and other adjustments made during the financial statement preparation process, looking for anything unusual or improper. And evaluating the overall presentation of the financial statements to ensure they comply with the applicable financial reporting framework like GAAP or IFRS. These are non-negotiable substantive steps.
Okay, baseline checks are always done. What are the main types of substantive procedures auditors use to dig deeper?
There are really two main categories. The first is tests of details.
Tests of details.
These are exactly what they sound like. They involve examining the specific details that make up an account balance or a class of transactions. This could mean vouching transactions back to supporting documents like invoices or contracts, tracing items forward to ensure they were recorded correctly, or directly confirming balances with third parties, like banks or customers. We use tests of details to gather evidence about the ending balance in an account, the individual transactions that flowed through it during the period, or often a combination of both.
Okay, getting into the weeds of individual items, what's the second type?
The second type is substantive analytical procedures.
Analytical procedures, like looking for patterns.
Exactly. These involve evaluations of financial information made by studying plausible relationships among both financial and non-financial data. The auditor develops an independent expectation of what an account balance or ratio should be, based on trends, industry data, relationships between accounts, or other information, and then compares that expectation to the company's recorded amount. If there's a significant difference, it warrants further investigation. Think about comparing this year's gross profit margin to last year's and the industry average. If it suddenly jumps way up without a clear reason, that's a red flag analytics would catch.
Ah, okay. Looking at the bigger picture trends and relationships.
Right. It's about whether the numbers make sense in context.
So do auditors typically use one type or the other, or both?
They can use either tests of details only or substantive analytical procedures only, though that's less common for significant balances, or very frequently a combination of both. The choice depends on the assertion being tested and the assessed risks.
Okay.
Analytical procedures can be very efficient and effective for providing broad assurance on large volumes of transactions that are predictable over time, like payroll or utility expenses.
Right, predictable stuff.
But tests of details are generally considered more effective for obtaining precise evidence about certain assertions, particularly existence and valuation. For example, directly confirming accounts receivable with customers provides stronger evidence about existence than analyzing receivable turnover ratios.
Makes sense. Direct confirmation is pretty solid.
Very solid. So the auditor weighs the risks and the nature of the account. If tests of controls showed controls were effective, maybe substantive analytics alone might suffice for some less risky assertions. But if controls were ineffective or weren't tested, then the auditor is much more likely to rely heavily on tests of details to get the assurance they need.
Okay. And the extent of these substantive procedures, how much do they do?
Again, more testing generally provides more evidence. The extent is heavily influenced by the overall risk of material misstatement. Higher assessed risk means the auditor can accept less detection risk. The risk their procedures won't catch misstatement,
Right.
which translates directly into needing a greater extent of substantive procedures, larger sample sizes, testing more items. Conversely, if control risk is low, because controls tested effectively, the auditor might be able to justify a reduced extent of substantive procedures compared to if controls were weak. For test of details, extent often directly relates to the sample size calculated.
Okay. And finally, the timing of substantive procedures. We touched on this earlier.
Yes. Substantive procedures can be performed at an interim date, before year end, at the period end itself, or sometimes even after period end for certain procedures.
Interim versus period end.
Performing substantive tests at an interim date, say confirming receivables in November, does increase the risk that material misstatements might arise between that date and the year end and go undetected.
The gap period risk.
Exactly. The longer the period between the interim test and year end, the greater that risk.
Yeah.
So the auditor needs to perform additional procedures to cover that remaining period. For high-risk areas, especially those involving significant risks like potential fraud, auditors strongly prefer to perform substantive procedures at or very near the period end to minimize that gap risk.
Get the most current picture for high risks.
Precisely. If an auditor does use interim testing, especially analytical procedures, they need to consider things like how predictable the account balance is, whether the company's accounting procedures are appropriate and consistently applied, and whether the information system can provide reliable information for the period under review and the remaining period.
Right.
And crucially, if misstatements are identified during interim testing, the auditor needs to reassess the risk and might need to modify the planned procedures for the remaining period or even repeat some tests at year-end.
Adjust the plan based on findings.
Always. And one last important point on timing for substantive tests. Evidence obtained from substantive procedures performed at a prior audit generally provides little or no evidence for the current period. Conditions change, balances change. You need fresh substantive evidence each year.
Fresh evidence every time for substantive tests.
Got it.
That's the rule.
Wow.
Yeah.
That was truly a deep dive. We've gone from understanding the entity and identifying risks all the way through designing and performing very specific tests of controls and substantive procedures. It's crystal clear that auditing is so much more than just crunching numbers.
It really is.
It's this incredibly systematic, strategic, almost detective-like approach to uncovering and addressing potential financial vulnerabilities. It's about ensuring the health and integrity of the financial information we all rely on.
Indeed. What we've explored today really highlights the layers of critical thinking, professional judgment, and, yes, skepticism involved in safeguarding financial information and ultimately protecting investors and the public interest. And maybe this raises an interesting question for you, the listener, to think about. We've talked about these structured approaches, identifying risks, assessing them based on likelihood and impact, developing specific responses.
How might these same principles apply beyond the world of finance? Think about your own work projects, maybe big personal decisions you're making, or even just planning for the future. Where could doing your own deep dive into potential risks, assessing them carefully, and planning responses help you ensure a more robust, successful outcome?
That's a really interesting thought. Applying that audit mindset elsewhere. Definitely something to mull over as you go about your day.
Food for thought.
Absolutely. Well, thanks so much for guiding us through that complex world.
My pleasure.
And thanks to all of you for joining us on this deep dive. Until next time, keep learning.